Bruce Kovner is a highly successful trader who has been active in the markets since the late 70s. On his first trade, he made $25,000 using a $3,000 debt that he borrowed against his MasterCard. Initially, after he placed the trade, his profits rose to $40,000 before declining down to $25,000. At which point, he decided to take profit and close his trade. After much success trading independently, Kovner decided to start his own trading firm. And within a few years, it had become one of the biggest hedge funds on the planet, managing over $15 billion in clients' assets. Mind you, this was back in the 1980s, and that's hell a lot of money, even if you do not take inflation into account and just consider it as $15 billion in today's money. Anyhow, Bruce's long-term track record of success means that we can learn a lot from the things he has said about trading over the years. His firm is almost 33 years old and is still running today, which speaks volume about his success. In this video, I have taken what I consider to be 6 of his most important lessons as to what is responsible for his success. And before I jump straight into the first one, please do me a small favor and hit that thumbs up button. I would really appreciate that. If you are new to the channel, do hit that subscribe button as well, because we upload new videos every single week. We also run a Telegram channel where we share our trade signals with you, and you can join our free Telegram channel via the link in the description down below. Key lesson number 1. Risk management is the most important thing to be well understood. Undertrade, undertrade, undertrade is my second piece of advice. Whatever you think your position ought to be, cut it at least in half. How much you risk on your trades and how you manage your money when trading is, in Bruce's eyes, the most important concept to have a deep understanding of when trading. He also says you should undertrade as much as possible. Well, I'm not too sure how many trades Bruce actually takes, but judging by the fact he repeats this again and again, I'm guessing it is far fewer than what you or I would consider to be small. I believe that the vast majority of retail traders take quite a large number of trades and overtrade. Rather than focusing on the best setups and risk management of 1 to 3% per trade, the vast majority of retail traders live and die by the next 5 or 10 trades due to poor risk management. It varies depending on the time frame you trade and the type of trader you are. But I believe that most traders take more trades than they need to. I guess why this occurs is because traders don't know which setups are their highest probability trades. Because they don't know a high probability trade from a low probability trade, that means they have to take all the trades which come up as part of their trading system, assuming that they even have one. Needless to say, depending on the actual trading method being used, this can be a significantly larger amount of trades than what they actually need to turn a good sizable profit. The last thing Bruce says is whatever size you plan on trading should be cut in half before you actually place the trade. This ties in with another of Bruce's quotes, which we will look at later on in the video, in which he says one of the biggest mistakes he sees novice traders make is taking trades which they risk a large portion of their account on. Novice traders typically tend to take big risks when they start out trading the Forex market or any other markets for that matter. Bruce is advising beginner traders to cut the size of their trade in half before placing it, because it is still likely to be far more than they should be risking. Key lesson number 2. Whenever I enter a position, I have a predetermined stop. That is the only way I can sleep. I know where I'm getting out before I get in. The position size of a trade is determined by the stop, and the stop is determined on a technical basis. Over here, Bruce is stressing the importance of having a stop loss placed on each trade you take. He says that the only way he can sleep at night with positions open is because he has a stop in a market which he knows will limit his losses in the event that something unexpected happens while he is sleeping. He also mentioned that the size of the trade he's placing is determined by the stop loss, and the location of his stop loss will always be on something he sees on a chart, not some arbitrary level based on his emotions or risk tolerance. Key lesson number 3. My experience with novice traders is that they trade 3 to 5 times too big. They are taking 5 to 10% risk on a trade when they should be taking 1 to 2% risk. The emotional burden of trading like this is substantial. On any given day, I could lose millions of dollars. If you personalize these losses, you can't trade. It takes a while for beginner traders to get a feel of how things work in a market and what you should and shouldn't do when it comes to trading the markets themselves. A lot of traders end up blowing their first accounts soon after they have begun trading because they fail to understand the risk involved with trading in the financial markets. They think risking 5 to 10% of their accounts on a single trade is small and is standard practice for people who trade the markets. But what they fail to realize is that 5 to 10% is a huge amount of money to be risking on a single trade. If a trader risks 10% of his account on each trade he places, that means he only needs to lose 10 trades in a row to lose all of the money in his account. It may seem unlikely to stumble upon 10 losing trades in a row, but it can and does happen, especially to beginner traders who have yet to form a trading plan or learn a robust trading strategy that places the odds in their favor. In fact, if you trade long enough, having a losing streak of 10 trades is not something that may happen. It's something that will definitely happen. It's a matter of time, even if you are a professional trader. If you stick to only risking 1 to 2% of your account on each trade, you will then be able to survive any losing streaks which come your way, and you have enough time as a beginner trader to survive the first few months of trading, which is really crucial in your development. Key lesson number 4. Fundamentalists who say they are not going to pay any attention to the charts are like a doctor who says he's not going to take a patient's temperature. This quote is a little jab at the people who say fundamentals are all you need to trade the market. Since the beginning of time, there has been an ongoing argument between fundamental traders and technical traders who go back and forth over which method is superior in trading the markets. Fundamental traders say there isn't any need to look at charts because the fundamentals tell them all they need to know, while traders who use technical analysis say fundamentals don't matter and everything you need to make money is contained in the charts. With this quote, Bruce is saying that fundamental traders who don't think there's any point in looking at a price chart of an asset are making a huge mistake, because the charts hold a wealth of information which cannot be discovered purely from looking at fundamentals alone. Bruce says he uses both fundamental analysis and technical analysis to make his trading decisions. By the way, in our Forex course, we also show you how to integrate both fundamental and technical analysis together to drastically improve your win rate. Access to our Forex course is free, and you just need to open an account with our sponsoring brokerage and deposit a minimum of $300. If that's something you're keen to learn, I will leave a link to the sponsorship deal that my team has arranged for you in the description down below. So moving on to key lesson number 5, the Heisenberg principle. If something is closely observed, the odds are it is going to be altered in the process. The more a price pattern is observed by speculators, the more prone you have false signals. The more the market is a product of non-speculative activity, the greater the significance of technical breakout. The trend is a concept which most traders have knowledge on and use in their trading of the markets. Due to the number of people who monitor the trend and use it heavily in their decision-making process, the concept of trend itself has changed to accommodate this. The Heisenberg principle applies to a lot of things we see in a market. For example, a really obvious head and shoulders pattern is unlikely to result in a successful trade if majority of the traders are trading it. It will be more profitable for the banks to move the market in the opposite direction to make all the people trading the head and shoulders pattern lose money. Key lesson number 6. Michael Marcus taught me one thing that is absolutely critical. You have to be willing to make mistakes regularly. There's nothing wrong with it. Michael taught me about making your best judgment, being wrong, making your next best judgment, being wrong, making your third best judgment, and then doubling your money. Michael Marcus was himself a very successful trader and actually taught many of the really successful traders. And one piece of advice Marcus gave Bruce was that you always have to be willing to make mistakes and that it was okay to make mistakes when trading. Now, retail traders like you and I tend to view mistakes differently. They believe that making a mistake is a bad thing and associate it with being bad at trading itself, which isn't necessarily true. They think that they have to be perfect in order to make money. I know this was certainly true for me in my earlier days. I would beat myself up mentally whenever I made a mistake, even a small one. Now, making mistake is a part of trading which you must live with. It is essential for your learning process too. If you never made any mistakes, you wouldn't be able to find out what you might be doing wrong or how you could improve your trading to get better results. And there you have it. These are the 6 key trading lessons which I consider are the most important trading lessons shared by Bruce Kovner. I highly recommend that you check out the Market Wizard series where Jack Swagger interviews him. As a successful trader, there is really so much you can learn from him, and I'm barely scratching the surface in this short summary video. I hope you got a ton of value, and don't forget to subscribe, and I'll catch you in the next one.